Hi, everybody. Ben Birkin, Vice President of Customer Success and Engagement here at Holistiplan. And in this video, we're going to talk a little bit about the solve for max and range calc functions within Holistiplan, which are huge aids in doing scenario planning and modeling and having to do things with what a computer is supposed to do, which is make your life a lot easier, as opposed to the iterative processes that most tax planning and other tax software currently uses. So you can see I'm already starting here within a scenario analysis page. This is one of our model households. This household is supposed to be a retired couple where both folks might be taking Social Security, but are not yet at required minimum distribution stage. So their pattern is that they've got income coming from dividends and interest. They've got some Social Security. And in this particular case, we modeled it so that they have $10,000 of long-term capital gains. One thing that I'll point out, and this is going to be key as we're thinking about what the range calc feature allows us to do, is notice that their gross Social Security of $27,000, which we haven't inflated from the previous year, only $10,633 of that is taxable. That's because the way the taxability of Social Security works, at most 85% of the benefit will be taxable, but depending on income, sometimes none of it is taxable. If Social Security is your only income, none of it is taxable. Sometimes 50% of it is taxable. There's a more complicated and nuanced calculation that goes into how much of your Social Security is actually taxable. We take care of all of that for you. So all you need to do is enter the gross amount. We'll calculate how much of that is taxable. But I highlight that because when we look at the range calc and the solve for max features, you're going to see some of these things show up. I'll start with solve for max. Solve for max, this is kind of like the easy button where all you care about is how much more income your clients could realize, either in terms of just basic ordinary income or capital gains income, before they're going to see a bump up to the next effective rate. And I stress effective rate because we try to move away from just thinking about things in marginal tax brackets, because as you'll see when we get to the range calc screen, marginal tax brackets are important, but they're not the only determining factor in terms of tax increases with higher and higher amounts of income. So solve for max will take us right up to the limit of where that next change in the effective rate might happen. You'll see when the dialog box comes up after it's done running, what's happening under the scenes is we're adding $500 over and over and over again to your client's picture until we see the next change in the effective rate. So this is telling us that we could add $5,000 of ordinary income or $11,000 of long-term capital gains before we see a change in the current rate based on this particular baseline scenario. Now, you might have already guessed this particular baseline scenario, income's pretty low, right? So total income's only about $43,000 after a standard deduction with a little bit of a charitable deduction. These folks are taking the charitable deduction in 2021 that's available to people who don't itemize. Now, they didn't max it out. They could have done $600. They only did $300. But our taxable income is less than $15,000, right? So that's going to put us in a pretty low tax bracket. In fact, it would put them in the marginal bracket of 10%, but you see total tax is zero. Why is total tax zero? Well, it's because this $14,783 is made up entirely of capital gains and qualified dividends, right? The deductions were so high that it wiped away all of the ordinary income, because deductions work first to counteract ordinary income before they start eating into capital gains and qualified dividends, because that allows the preservation of those more preferential rates for capital gains and qualified dividends. Now, most folks know that the rate for long-term capital gains is 15%, but there's a lower rate of 0% for any amount of your taxable income below $80,000 for married filing joint folks in 2020 and 2021, where you actually get a 0% rate. So that's why we see down at the very bottom, our total tax is zero. There's actually more deductions that we could use. So the next $1,000 would be taxed at 0%, and we're still well within that 0% tax bucket for capital gains as well. So this is a pretty low income couple. The thought process might immediately be, wow, if I've got IRA assets, this is a great opportunity to do a Roth conversion and pay very little taxes on it. Totally understandable. But the question then becomes how much, right? So that solve for max button told us that we could do a $5,000 Roth IRA contribution before we see a change in our tax rate. Since our tax rate is 0, that means we've got $5,000 of ordinary income to work with where there's no federal income tax at all. That's kind of nice to know, but you might also want to know, well, that's not very much. And what about things beyond that $5,000? That's what range calc allows us to do. So when I push the range calc button, what we're going to see, there are going to be 2 tables or 2 charts. The first one, the one on top, is the ordinary income chart. Now, ordinary income is going to start telling us, A, what's our baseline taxable income? So remember from the previous page, it's a little less than $15,000. But what's also our baseline ordinary income? So how much ordinary income do we start with before we start adding additional increments of $1,000, which is what range calc shows. Range calc's goal is to show you the tax rate of adding things in $1,000 increments to tell you the rate of tax that those $1,000 increments will be hit with. We'll talk about these different colors in a second, but just bear with me. Down below, you'll see the same thing for capital gains. So how much is the rate of tax as you add increments of $1,000 worth of capital gains? Okay, so let's start with the top one, because we thought our assumption going into this was, wow, we've got an opportunity for a Roth conversion. We see what we saw when we had the solve for max. The next jump in the federal tax doesn't happen until we hit $5,000. And you actually see that down here as well, where as we add $1,000, $2,000, $3,000, and this is our axis right here. So this axis is adding money right on top of the baseline. So our 0, 0 axis is we haven't added any money, and then when we get to 1,000, we've added $1,000 of ordinary income. Nothing happens until we get to about $5,000, right? $6,000. At $6,000, we see this spike, right? We see this spike in the effective rate of that $6,000. And what's going on here? Well, there's 2 things, right? There's 2 different colors. Every color in the range calc chart corresponds to something, some other form of tax that's happening. And the black line that's at the top shows you the total federal tax impact. So the 2 colors here, one of which should be expected, right? This is just the marginal bracket, our 10% marginal bracket until we bump up to the 12% bracket after adding about $19,000 or so of income. But we also see purple. Purple is Social Security taxation phase-in. What this means is that with this particular couple, once we've added about $6,000 of ordinary income, yes, we have to pay marginal bracket tax on that, but we're also subjecting some Social Security that wasn't being taxed before to being taxed now. And the purple section will exist until we've pushed all of the Social Security that could be taxed into the taxation bucket. So all this is telling you is that your journey from about, we'll call that $6,000 of ordinary income up to about $16,000 of income. Once you've hit $16,000 of additional ordinary income, adding another $1,000 won't change how much of your Social Security is taxable. You've already topped it out, right? So at this point, this little point right here, we've added enough ordinary income that 85% of this client's Social Security is subject to taxation. And that's how all of these starts and stops, these mountains work. This is one of the most common ones, right? So what do we see here? We see that adding about $53,000, $54,000 of income starts adding in this red hump. This is critical because most of the time, if we condition our brains to think only about marginal brackets, we know that the top of the 12% bracket doesn't happen until somewhere around, I don't know, $77,000, $78,000, $80,000. So maybe I should do a Roth conversion all the way up to that. But if you do that, you are ignoring the impact that adding additional ordinary income has on the taxation of capital gains. Now I'm going to break for a second here and start drawing on my screen because sometimes this can be a complicated concept, but one that's so valuable. So here's our threshold of about $80,000 of taxable income. And below this amount, we'll start with our baseline of ordinary income. We'll call that O. And then on top of that, we'll call that C for capital gains. And I apologize, the handwriting's not so great. Below this $80,000 threshold, this section gets taxed at a rate of 0%, right? Because any amount of capital gains or long-term capital gains or qualified dividends that make up taxable income below that $80,000 taxable income threshold receive a 0% rate. So what's happening here? What's happening here is we've added ordinary income. So we've added it to the base, but we've kept capital gains the same. So now we increase our amount of ordinary income by a little bit. Capital gain stays about the same. What's happening? Well, this section that's below the $80,000 threshold is still being taxed at a rate of 0%. But this little bit that just peaked over that $80,000 threshold, that's getting taxed at a rate of 15%. What that means is that at this point right here, as you've added ordinary income, yes, you have to pay marginal bracket tax on that ordinary income, but you also have to consider that you've now pushed some capital gains into the 15% bucket. So the effective rate starting here and going this way on ordinary income isn't just the 12% marginal bracket, it's 12 plus 15, it's actually a 27% rate. So it's more expensive than you might have otherwise thought. I'm going to erase these now so that we don't get things too cluttered up. One of the questions we often receive is, does this mean when I've hit this point right here, it looks like capital gains go away? That doesn't seem right. Does that mean I don't have to pay capital gains taxes anymore? And the answer is, of course not. You still have to pay capital gains tax, or your client does. But it's important here to remember, what is range calc showing me? Range calc is showing me the tax impact of adding additional dollar amounts in these $1,000 increments. So what's happening right here, if we come back to our example of here's our $80,000 threshold, and here's our baseline, right? Here's O, here's C. When we're at this point, we've added so much ordinary income that the ordinary income is taking up all of the $80,000 bucket, right? And we've pushed all of the capital gains over that threshold so that every dollar of capital gains and qualified dividends is being taxed at a rate of 15%, such that as you add additional amount of ordinary income, you're not going to change this math anymore, right? You can add all the income that you want to. On the ordinary side, your capital gains are still going to be taxed at a rate of 15% until you've added so much, and we can actually show that, until you've added so much that you're actually going to bump things up to the next level of qualified dividends and capital gains, which is when they're taxed at 20%, right? And this can be an interesting case too. We know that going from 0 to 15 effectively is a 15% rate. What you see when you've added so much is that it looks like you're only paying 5% on capital gains. That's not what's happening. What's happening is that you're seeing an increase from the 15% rate to the 20% rate, which is why adding additional amounts of ordinary income at this high end range increases the tax rate by upping what you have to pay on the amount of capital gains that are now in the 20% bracket by 5%, right? Let me bring the range back down so that it looks a little bit more granular, because there's one other item on here that I think is worth talking about. And that is this little brown section. The brown section is going to be where the net investment income tax comes into play, right? So the net investment income tax is a 3.8% tax that gets applied to either net investment income, which is going to be qualified dividends, interest, capital gains, or things like that, or the amount that you're over the threshold where the NIT applies, which for married filing joint folks is $250,000. What this section is telling us right here, if I can bring my drawing tool back in, what this section is telling us right here is that at this point, we've added enough income that we've broken past that $250,000 threshold. Adding additional amounts of ordinary income in here will be hit with a 3.8% tax, because in this range, the threshold, the amount that we're over the threshold, so the threshold overage, is less than investment income. Right? That's what's happening within this range. The amount that we're over the threshold is less than the investment income. So that's where the 3.8% tax is going to be applied. What's happening at this point, when we've added, I don't even know how much income that is, but what's happening here is that this switches. And now the investment income is the lesser of the two, such that adding additional amounts of ordinary income over here, you won't subject yourself to any more net investment income tax. You'll still have to pay it, but the 3.8% tax is going to be applied to the investment income bucket which by nature of range calc is being held static, right? Because in this chart, we're not changing how much qualified dividends or how much capital gains that you're being hit with. That's held static. So once we hit this point and we see this change from which one is the lesser, adding more ordinary income won't change that NIT calculation. And that's going to be a little bit different down below in the long-term capital gains. So here in the long-term capital gains section, we see that, as we might expect, there's a lot of room to go before we actually trigger the 15% tax rate, right? Because we have very little long-term capital gains and qualified dividends to start with, right? So we just have 24,500 of it. If in this section, we're keeping ordinary income static, we've got a lot of room to go to realize capital gains while still paying a 0% rate on those capital gains. One thing to keep in mind, though, is the calculation for taxable Social Security doesn't make a distinction between ordinary income and long-term capital gains, right? It's all just income. It's all just AGI. So what you're seeing in this section right here is the impact that adding additional capital gains has, again, on your total tax picture. When you've added capital gains of about, call that about $11,500, $12,000, you start pushing Social Security into the bucket where it becomes taxable. It's a pretty narrow peak, but the attribution, it gets a little funky, but you're pushing Social Security that wasn't taxable to being taxable, and Social Security's taxes ordinary income. So you get this small little peak here where, yeah, there's a little bit of a federal tax impact, even though the capital gains themselves are being taxed at a 0% rate. Once we've added, let's call that about $50,000-ish, $54,000, $54,000, $55,000, we're now in that 15% range where we will be for a very long time. You see again here the impact of the NIT, so the net investment income tax. Remember, in this case, when we're in the long-term capital gains chart, ordinary income is being held stable. Adding investment income to this piece will always trigger the NIT once you've gone over the threshold, right? Once we've exceeded that $250,000 threshold for married filing joint folks, adding capital gains will always have that net investment income tax applied to it, because adding capital gains adds to both investment income and the amount that you're over the threshold. So those two things move in lockstep when we're thinking about adding additional long-term capital gains. A couple of other points to talk about, because this is a couple where at least one person is over the age of 65, you'll see the dotted lines show up here. These are the breakpoints for the Medicare surcharges, where if you go over by just $1, that's triggered. So this is a per person number here, but it's per year. And this is the combination of the premium adjustments to both Medicare's Part B and D. So if we added $126,000 of ordinary income, $125,000 of ordinary income, this couple would see a $965 per year per person adjustment to their Medicare premiums. One other thing that I wanted to point out, and this comes up a lot within the support group, just because you see a high rate doesn't necessarily make things red alert bad, right? All it's telling you is that, yeah, if you're in this zone and you add another $1,000, the rate on that $1,000 by itself will be 27%. But sometimes we get so hung up on rates that we don't always think about the actual dollar impact on that. So what do I mean by that? Well, these folks don't have a whole bunch of qualified dividends and long-term capital gains to begin with. So the rate might be high, but the actual dollar impact might not be that big of a deal. Also, by its design, range calc is just telling you the tax rate of the next $1,000. You could actually, if you wanted to, just see, okay, I've got a baseline ordinary income of 0. If I added $79,000 to my baseline ordinary income of 0, this table is telling me what the total tax will be. So the total tax will be about $13,000. The effective tax on that last $1,000 was 20.5%. But on the whole, if I just divide $13,000 by $13,000 by $79,000, my effective rate on the whole thing is going to be less than 20%, right? It's going to be in the 16 to 17% range. Now, you might, as a financial planning decision, say, I'm okay paying that rate, even though, yeah, I know the last dollar, I should say, the last dollar might have been kind of expensive. at 20.5%, this combined 15 and 12% bracket between the capital gains, but maybe I'm okay with that. So it's, the message here isn't that's a good thing, that's a bad thing. It's just more, there's a little bit more nuance than just saying, oh, wow, that's super expensive, I never want to do it. Well, maybe you do, because the tax rate on the whole thing might not be that big of a deal. Or you could look at this and say, yeah, I don't want to deal with that. I just want to keep things as cheap as possible. So range calc is telling me, as long as I don't go over $52,000, $53,000 of ordinary income, all those capital gains will still be taxed at a rate of 0. And maybe I'm good with that. But that's what range calc is intended to do. There are a bunch of other examples that you could see. We can't go over everything, but sometimes you'll see credits phasing in and phasing out. So if there were child tax credits that phased in and out, you would see the beginning of a phase out range and the end of a phase out range. If there are ACA, so Obamacare credits, you'll see that phasing out too, as you add additional amounts of ordinary income or capital gains income to your picture. There are a lot of different colors that will show up here. We know that sometimes it can be hard to remember everything, which is why within the range calc screen, we've got this what does it mean tab. If you open up this what does it mean tab, you'll actually see a bunch of different drop-down items where if you pick one of them, and let's just pick, and they're divided out between ordinary income and the long-term capital gains chart. These are the most common things. So if I say, I don't remember what it means for that purple Social Security spike when I see it, if I click on that, you'll see a description of what it means when you see that. Same thing for the net investment income tax. What does it mean when I see the brown net investment income tax on my ordinary income chart, right? So hopefully this has been helpful. Hopefully this leaves you with a better understanding of range calc and how powerful of a feature it can be. We look forward to seeing you next time.